from consolidated statement of financial position. A simple question, not really difficult. You guys have already read it. I'll read it quickly with you, and then we'll start doing it. The following are the draft statement of financial position of party company and streamer company as at 30th September 2005. Generally, the entity on the left side is parent. This is on the subsidiary or associate, whatever. Generally happens. So always pay attention to the dates. The financial statements are produced on 30th September 2005. We do not need to read all of these numbers. We will read them later. It's just extra waste of time because this information, if you even read how much are the PPE here, you can have a quick look, but there is no need to pay attention to the numbers at this time. We start going straight, we go to the requirement. What is the requirement? And then we see the notes. So the requirement is prepare the consolidated statement of financial position as at 30th September 2005. We start reading the notes because everything will come out from here. Okay. So on 1st October 2004, party company acquired 80% of the share capital of streamer. Dates are very important. 1st October 2004, you acquired 80% of the share capital of streamer. Financial statements are 30th September 2005, which means that there is a full 1 year period. At this date, the retained earnings of streamer company were 34 million. So acquisition, net assets at acquisition. So retained earnings will go there, 34 million. And the revaluation surplus was 4 million. Okay, 34 plus 4, it is also net asset. Party company paid an initial cash amount of 92 million. So they paid some consideration in cash and agreed to pay the owners of streamer company 28 million on 1st October 2006, which means 2 years later. 2 years later, they will pay 28 million for the deferred consideration. And deferred consideration, 28 million, is always discounted to the present value. It's a liability. It's a liability, but it is after 2 years. So we need to find out the present value of this thing. The accountant has recorded the full amounts of both elements. Now you see, this is a mistake. Accountant has put the full amount, which means accountant included 28 million. We should not include 28 in consideration. He actually take full amount. We will be using present value. Party company has a cost of capital of 8% and the appropriate discount rate is 0.857. 0.857 is 2-year discount factor. You can use this number. Even if you do this number, answer should come the same. So it means that we will be doing 28 million into 0.857, and that will give us 25, 26 million, whatever we will see. Or otherwise, if they don't give you the 0.857, let's suppose, in that case, you should say 28 million divided by 1.08 power 2. If you are not comfortable with power 2, you can divide it 2 times by 1.08. Okay, on calculator, if you can't put power 2, then 28 divided by 1.08 divided by 1.08, you get the same numbers. Okay, so one thing, this note, first note, it tells us about consideration, nothing else. This note is about consideration. Second note, on 1st October 2004, which means the acquisition date, the fair value of streamer company. So this second note is going to be about changes in fair value. Fair value of streamer company net assets were equal to their carrying amounts, with the exception of some inventory which had cost 3 million but had a fair value of 36 million. I think they are making some mistake here. It can't be 3 million and 36 million. This should be 3.6 million actually. So let's assume that it is 3.6 million. Otherwise, it does not make any sense that book value is 3 of inventory and inventory is 36. Not logical. It's 3.6. On 30th September 2005, which means end of the year, 10% of these goods remain in the inventories of streamer company. So there is a fair value, upward devaluation of 600,000, I can say 3 million to 3.6 million. And then these goods are not in the inventory because they have been sold out. Only 10% are in the book, in the balance sheet. Okay, so we'll make this adjustment. In consolidation questions, what you need to do working. You will call it working 1, consideration, working 2, goodwill, working 3, fair value adjustment, working 4, unrealized profit. Once you do these workings, then you just need to put the things in place. Workings are challenge. Working, if your workings are correct, ultimately, and you get marks on workings, by the way. During the year, party company sold goods totaling 8 million to streamer company at a gross profit margin, so not markup, but margin of 25%. So this is about intragroup trading. And we will find out what is PUP, unrealized profit. So during the year, they sold goods for 8 million with a margin of 25%. So it means 25% of 8 million because sold goods totaling 8 million. Invoice value is 8 million. Margin is 25%. 30th September 2005. Streamer company still held 1 million of these goods in inventory. Party company's normal margin to third parties is 45%. That's very interesting. Because of intragroup transaction, they are selling goods at a lower margin. By the way, you always need to be attentive with the wordings because sometimes they change the wordings, and students, they think that, oh, this is margin, this is 8 million. You know what they otherwise could have done? And sometimes they do. They will add one sentence here. They would say, during the year, party company sold goods which had cost to party company 8 million, like this. During the year, party company sold goods which had cost 8 million. So when they tell you that 8 million, so now it is cost. Now you can't take 25% of 8 million. Like I said, that if I don't write this thing, I can see that this 8 million is the selling price and I need to calculate margin. So I will take 25% of the selling price, which is 8 million. But if they tell me that this 8 million was actually the cost, then I cannot take 25% of it because 25% is margin and margin means I have to calculate 25% of the selling price. But here this is cost price. So you need to be careful, okay, that I'm going to take this 25% of the selling price. This 8 million, is it selling price or not before you do your calculation? Because they put this little trick and your calculation will be wrong. The party group uses the fair value method to value non-controlling interest. At acquisition, the non-controlling interest was valued at 15 million. So we understood that we just completed this thing, how to measure NCI. So they are measuring NCI at fair value, and fair value, we don't need to calculate, they already have given us, it is 15 million, life is easy, no problems. The only issue here that if there had been any impairment, now there is no note to the impairment. You will calculate your goodwill, okay? You will calculate your goodwill. Let's suppose goodwill comes out to be 5 million. And then they will say, end of the year, the goodwill is, let's call it 4 million. So it means that there is 1 million impairment. If this question had asked us 1 million impairment, and then because NCI, they are taking 80%, so 20%. So then what you do, this 1 million, 800,000 you would have subtracted from the parent's share, and 200,000 you would have subtracted from the NCI share, because they are measuring it at fair value. Whenever they say that goodwill is measured at fair value, immediately start seeing, is there any impairment or not? Because if there's an impairment, you should keep in mind that I will subtract this impairment, I will charge some part of the impairment to NCI as well. These are the little clues which you need to keep in your mind. So let's start doing this question. I'll make this one small, this one like this, and this one I will make further bigger because I want to show the numbers, and here I will put my final numbers. You start with, call it working one. Working one could be, before you start, you need to be very clear in your mind that is it a subsidiary or not. By the way, always remember, goodwill will only incur in case of a subsidiary. Remember, subsidiary where you have control. So control is there and it is subsidiary. In case of associate, there is no goodwill. Associates do not have goodwill. Goodwill is only done between a parent and a subsidiary when you have control. So they are getting 80%, so it is a subsidiary. And it is possible that there is an entity called Q, and there is an entity called R. P purchased Q like 70%. Then P also purchased R like 60%. So it means that this is subsidiary and this is also subsidiary. If you have two subsidiaries, you will have two goodwills. You need to calculate this goodwill separately and you need to calculate this goodwill separately. In case of two subsidiaries. If there are three subsidiaries, there will be three goodwills. If there is an associate, there is no goodwill. Anyways, first thing we need to establish that do we have control? Answer is yes. How much do we own? 80%. How much is the post-acquisition period? How much is the post-acquisition period? This is the first thing which is in my mind. Post-acquisition period is 1 year. So once I am clear about these things, I start doing my calculations. I can call it my working number one. You remember that you need to calculate goodwill actually. The first thing you need to calculate goodwill, but before you do goodwill, you need to find out consideration paid, how much you have paid consideration. Then your working number two should be how much was the net assets. And based on these two things, then your working number three is actually goodwill. I mean, my objective is to calculate goodwill first, but I can't do it without doing consideration paid. So if I do consideration paid, it is like parent, cash consideration. Then it is parent deferred consideration. We remember that there was some deferred. And then you have here, the third thing was your NCI. And just write it down fair value so that you don't forget things where you are coming from. So parent cash consideration was given, I think 92 million. It was given something, yeah, 92 million. So I'll just write down 92 million. And by the way, throughout your preparation, when you are doing preparation at home and when you do an exam, so it's 92 million. If I see it is called 92 million. So 92 millions are written like 92,000,000. That looks pretty odd, okay? It takes a lot of space, especially when we were doing it manually. Putting too many zeros, it actually clutters things, and it also, especially when you were doing it manually, paper-based exams, you always were short of space, and so many zeros makes no sense. So throughout your entire preparation, you should always make like a rule that I'm going to put 3 zeros on the top, and 92 million, I will call it 92,000. It looks more professional, and it saves space, it saves time. Every time you are writing 6 zeros does not make sense. So 92 million is my cash. Then I have deferred consideration, which is, how much? Deferred is 28 million, okay? And your discount factor, remember, this is deferred consideration, which you have to pay after 2 years. And the 2-year discount factor is 0.857. So what we are going to do, we will just write down deferred consideration is here, 28 million and multiplied by 0.857. I put this column because I want to show this calculation. Then I take it here, I make a copy paste and I put equals to. So if I don't have this column, nobody would understand where this number came from. How did you get 23,996? And you remember that what will happen? The implication of this thing is that I have to pay 28 million here. I find out the present value, which is 23 million, and then it is paid after 2 years. I will unwind it for 2 years, and I will unwind it with 8% because they gave us in the question, they gave us that 8% is the cost of capital. So 23 million multiplied by 8%, maybe it is 3 million, I don't know. So that 3 million is your finance cost. Okay, and then it becomes here 26. So here the number becomes 26. Again, you will add 8%, and that becomes, for example, I don't know, maybe 3 million or 2 million, because together it will make 28. So let's call it this is 2 and this is 3. Okay, so this 2 million will go to my P&L of year 1 as finance cost. This 3 million will go to P&L of year 2 as finance cost. Unwinding. This will decrease your retained earning. What in this question is said that the accountant recorded it in full, which means accountant recorded full 28 million, and he did not charge this thing to P&L. So you need to charge this thing to the P&L, and on the balance sheet, you will take only opening number plus this one. Am I clear on this thing? Unwinding concept. Okay. Then what do we have? NCI fair value. The fair value of NCI was given as 15 million. It's a straight number. We will put 15 million here, and we just make a total, and just make a little bit of formatting, and like this. So this is your consideration. The consideration which has been consideration transferred. You can call it transferred or paid, whatever. After this, we need to find out the net assets. Okay. Now, remember, there are different formats which you can use for doing this net assets. Like, for example, what I would rather prefer, and which actually helps us a lot. Okay, let's call it like this. You will find out net assets at acquisition. Right? This is what is your objective. So what are the net assets at acquisition date? So you have your share capital. You have your retained earnings. This is also given in the question. And then I think, if I'm not mistaken, they mentioned some reserves as well. So how much was the share capital? If I go back, it is 60 million. If I see it from the balance sheet, the share capital is given as 60 million. But this retained earnings I will not take, because these retained earnings are at the end of the year. I will only take retained earnings and I will also not take these reserves. These numbers I will take from the data which has been given in the question. For example, they told us here in this question, the first one, you see here, on 1st October, they acquired 80%. At this date, retained earnings were 34 and revaluation surplus was 4. Okay, so I'm going to take these numbers. So 34 million, 4 million. So I'll take here my share capital, which is 60 million. And by the way, I'm sorry for this, because this point is my adjustments. I'll just put it like this. If I'm doing it, I will make a wrap text. Wrap text I will do so that it looks like this. So I will call it, because numbers I'm taking here, the final numbers. So retained earnings were 34 million and reserves were 4 million. Reserves were 4 million. But then there was one more thing, which is this one. Fair value adjustment. Fair value adjustment will increase the net assets, because on the date of acquisition, the goods which were 3 million, they had a fair value of 3.6 million, not 36, 3.6 million. So this is a fair value adjustment at the date of acquisition. So at the date of acquisition, this is I'm making. So I'll call it fair value adjustment on inventory, which is 600K. Now these are the net assets. So this is the net asset which has been provided by the subsidiary. This is subsidiary. This is subsidiary. This is group adjustment because we believe they might be showing inventory at 3 million, but we believe that it is 3.6 million. So we make this adjustment. Once you do that, you actually have now your numbers are there. This is your net assets of streamer at acquisition. Okay, like the full sentence: net assets of streamer at acquisition 98.6 million. I will again make a little bit of formatting here, and then if I say my goodwill, of course goodwill I will write down here. I will say consideration. Then I will say net assets. And I will say, working, this is my working 1, I'm taking the number, working 2, I'm taking the number. So it is better that you write down these things so that examiner knows where you are taking these numbers. And this I will multiply with -1, and I do something like this, and I get a number 32,396, which is my goodwill. Any question until here? And this is going to be my goodwill. So you have done your consideration calculation, net assets calculation, and goodwill calculation. Now, this working, which is your net assets working, do you remember that there was a concept of post-acquisition profit, and what do you do with the post-acquisition profit? Remember? In our previous calculation, when we were calculating NCI at reporting date, so we said that whatever is the post-acquisition profit, that is divided between the parent and the NCI. Do you remember any such thing? Post-acquisition profit. What happens to post-acquisition profit? Please, you need to tell me before I move forward. Okay. Thank you for contribution. Actually, we said that in previous questions, we were taking the post-acquisition profit, and some part we were giving it to NCI, and some part we were giving it to the parent. But it is not actually about post-acquisition profits. It is not. It is about your net assets at the date of acquisition and net assets on the reporting date, which we call changes in the post-acquisition period. So what you divide between the parent and the NCI is not only post-acquisition profit. It is about the total change in the net assets. For example, I make this thing net assets at acquisition. It is a very good idea that you are using this number. You take this opportunity to find out and net assets at reporting date. This format is better format. That at the same place you write down this. For example, what is your share capital at the beginning was 60 million, and at the reporting date it is 60 million. So I write down here 60 million. Then my retained earnings were 34 million. How much are retained earnings now? 36.5 million. So I write down here 36.5 million. Your reserves were 4 million before. How much are your reserves now? Reserves now are 4 million. So you write down again 4 million. Then comes this number, fair value adjustment on inventory. It was 600 at the date of acquisition. How much it should be now here? So when you got this subsidiary, they had some inventory in their balance sheet. They had some inventory for 3 million, and you believe that it is 3.6. So you booked 600,000 here. How much is left here? Do we still have in the balance sheet inventory with 600,000 fair value adjustment? Please read this thing. I want you to do it yourself. Read this thing. What do you understand? Just this part. It's 10% of the goods you made.
Yeah, this is towards the provision for unrealized profit.
So no, not unrealized profit. It means that the goods in the fair value adjustment on the reporting date is only 60. So it was 600 before. All of the goods were sold. Only 10% of the goods are remaining. So the fair value adjustment is also 10% remaining. Does it make sense? In your balance sheet, on your balance sheet value at the acquisition date, the difference, for example, how did you get the 600? We got this 3 million. And 3.6 million. And we said that there is an additional profit, there's an additional value in the net assets, which is 600,000. Now these goods are sold. On the reporting date, the balance sheet has only 10% of that. If inventory is 10%, this 600 into 10%, this is also 60. Only you've got 60,000 of that fair value left on the balance sheet. And then you say, here, you make a column, you call it, change in net assets. And I will take the same format, change in the net assets. So I'll start subtracting this, closing, minus opening, and I'll take copy paste. And we make it like this. So it means that from the reporting date when we started, on the reporting date, or at the acquisition date, this subsidiary streamer, it had net assets of 98.6 million. 1 year later, they had net assets of 100,560. The increase or the change in the net assets is 1.960, and this 1.960 should be distributed between the parent and the NCI. So it's not only about finding out the post-acquisition profit, it is actually finding about everything, because shareholders, they do not own only profit. Shareholders, they own net assets, which is equity. So what is the equity before? What is the equity later on? What is the difference in equity? All of that difference should be divided between the two. Am I clear on this thing or not? So now I can say that, let me write down here. So working 4, I will call it, and let me just say, change in net assets. Okay, change in net assets, and let me call it like, as per working 2. This was working 2, I think. Yeah, working 2. And I'll take this number here, 1960. So this is 1960. I'm going to divide it or distribute it between the parent and the NCI. So if I have to calculate working number 5, which is called NCI at reporting date. Remember we said that you had big 5, big 6. You need to find out how much is the NCI at reporting date, and the formula for that was NCI at acquisition and plus NCI's share in post-acquisition net assets. What are the post-acquisition net assets? I just need to create some space for that. So NCI at acquisition, I'll take the number from here, which is given, and then here I will take the number. What is the post-acquisition? Now remember, this profit of 1960, I'm taking 1960. And how much of this should I give it to the subsidiary or to the NCI? 20%, I suppose. I'll take 20%. I'll put equals to sign. And this is your NCI at reporting date, 15392. This working is also done. Where do we show this NCI acquisition? When you will make your final balance sheet. final balance sheet, you will make the share capital, share premium, retained earning reserves, whatever. You will show their equity belonging to the parent and equity belonging to the NCI. So this is actually the equity or the value of NCI at the end of the period. Now, one question comes up here. There was intra-group transaction, goods were sold, and there was some PUP. Do we need to subtract this PUP from here? Why did it not affect the NCI calculation? See, who is selling the goods? Subsidiary is selling the good or parent is selling the good? Let's see who is the parent. Party company is parent. And who is selling the goods? Party company sold goods to streamer, which means parent is selling to the streamer, which means that unrealized profit lies in the parent. Imagine that not party is selling, but streamer is selling to party. If this had happened, if subsidiary had sold goods to the parent, then what you need to do? Can you tell me? Then what you would have done? When you were making this net asset working, you would have actually created one more line and you would have subtracted the unrealized profit from this 1960. Let's suppose you would say that, like, if the subsidiary had sold goods, and let's suppose that unrealized PUP, unrealized profit is 200, then you should subtract 200 from here, whatever is 1760, and from that you should give 20%. In this case, because parent is selling goods, so I don't need to make this adjustment. I don't need to adjust subsidiary's profit. Okay, am I clear on that? Are we clear? How much is your unrealized profit? Can you tell me how much is unrealized profit? What is the value of goods sold? Sales, intra-group sales, parent to subsidiary. How much was that? 8 million. Profit is margin. How much is margin? 25%. So it means that 8 million into 0.25. So I take this number here. So it means that my intra-group profit was 2 million. And how much is unrealized? Unrealized profit, which you call provision for unrealized profit, PUP. So 2 million. How much is the inventory at the end of the year?
1 million.
Okay.
10%.
It is, no, not 10%. It is actually less because total value was, so I don't need to do it in this way because I thought that they have given us some percentage of the value. Sometimes they say 20% of the goods are in stock, 20%. So then I say if 2 million is the total profit, then 20% of that profit is unrealized. In this case, they have told us that, closing inventory is 1 million. So they have given us a straight number and unrealized profit would be 25%. So you would take, 25%, yeah. 250 is unrealized profit. 250 is unrealized profit. I'm going to subtract it. I'm going to subtract it from, the parent's retained earning. When you will calculate the group retained earning, that is a time when you should be subtracting this 250. Are we clear? So now let's do our working number 6, which is group retained earning, and we will finish with this thing. Once we do this working, we only need to put it in format. That's all. There's nothing else. Nothing else. Very simple standard. If you remember big 6 type of things, which I told you the workings. So the first question which we are doing is which involve these things. So how do we start with group retained earnings? You need to consider group retained earning will include parents retained earning total, not 1 year, total. Then parents share in post-acquisition retained earning, in post-acquisition retained earning of subsidiary or net assets, whatever, in post-acquisition change in net assets. Change in net assets of subsidiary. Let's take more space again. Just moving there. Then you will have if there is any impairment, I would have subtracted. I'm not subtracting. Deferred tax adjustments are not there. Later on, you will see deferred tax adjustments. Everything will be coming in, and you will have this unrealized profit. And then you have unwinding of deferred consideration. Okay. So parent retained earning, I can take it from the numbers which they have given us. How much is that parent retained earning? This is parent retained earnings are given somewhere here. This number. I will take this 210,000 total. So 210,000 is, to bring this a little bit here. 210,000. Parents share in net assets. I will take this 1960, put it here, and just make it 80%. So parent will take 80% of that. Then unrealized profit would be subtracted because this decreases the profit. And then unwinding of deferred consideration. Deferred consideration discount rate was 8%. They tell us that your cost of capital is 8%. So I will take my initial opening balance of deferred consideration with 8%. How much is that? 23,996. So 23,996 into 8%. Okay. So this is my finance cost, and that is also going to decrease my retained earning because that is the cost element. So I make a total of these things, and that gives me some number 209,398, and that is my group retained earning or parent retained earning. I would rather call it parent retained earning. Okay. 29,398. Any question until here? Once you are done with this thing, all of your workings are done. In some questions, they will tell you that there is, because here they made inventory fair value. Maybe they made some fair value of PPE. That it becomes a little bit more challenging because you have to calculate extra depreciation. Sometimes they add some financial instrument inside, some bonds have been issued. Maybe intragroup dividends have been paid or received. Intragroup, everything will be removed. For example, parent gave loan to subsidiary, and then subsidiary is paying interest. So that interest is shown in parent's investment income or somewhere. That should be removed. Intragroup interest, intragroup dividends, everything should be removed. Anything which is intragroup. Sometimes intragroup non-current assets are sold. That I will explain you next time actually. Sale of non-current assets, because that requires 2-3 additional calculations. So intragroup sale of assets I will do it. I'll explain next time. So let's make it like this. I will call it consolidated statement of financial position for party group. Okay, let's call it like this. And you've got non-current assets, you've got current assets, which gives you total assets. Total assets. After that, oh my god, where did I go? After that, I will write down, equity and liability. This is the same structure for balance sheet. Here I will put equity. Then I will write down any non-current liabilities. Then I need to write down my current liabilities. And finally, I will say total equity and liabilities. So now I need to fill in the numbers. Now, if you pay attention that there are many items on the balance sheet, which we, and let me just, drag them down so that we don't have to, how to say, because I need to explain a few things here. So I don't want to scroll a lot. So we keep these things in front and we then start speaking these numbers, okay? Like this. Few things to understand here. There are some intra-group things which you need to cancel. Generally, on your balance sheet, remember that these are single company financial statements, okay? These are not group. When you make the group balance sheet, the investments which you make in subsidiary, they are cancelled out with the, like we said that, consolidation is the process of adding together, like parent non-current asset plus subsidiary non-current asset, parent current asset plus subsidiary current asset, minus some intra-group things, minus. Generally it is plus, but there are some minus as well. But this share capital, you will never add. You will never say parent share capital plus subsidiary share capital. We will ignore this thing, okay? And the counter side is that we ignore the investments. Always remember, in consolidation, you show the investments which are made only for associates. Subsidiary investments are not shown. It is possible that this party company has made investments in different things. So this 120,000, maybe it is because of this streamer, it is X, it is Y. X will come, it is associate if, Y will come if it is associate. This thing will not come. So what I'm saying, trying to say that the investments and the equity share capital, they cancel out each other. We will not take this number. And we will also not take this number if it belongs to the subsidiary. If it belongs to associate, then we can take. Now, in this particular question, for example, we start with not NCI, I'm sorry, it is NC, NCA, which I call non-current asset. Okay, let me write down for non-current assets. So in non-current assets, you've got PPE, and PPE is 392,000 plus 84,000. There is no fair value adjustment of PPE. If they tell you that the fair value was higher 5 million, then you should add 5 million minus the depreciation on this 5 million. If they say that fair value has increased by 5 million and there is 10% depreciation, so you add 5 million and you subtract the depreciation on this 5 million. But in our case, there is no fair value adjustment of PPE. That makes life simple and easy. We just take these two numbers and we add them up. Then comes my investments. Now, I know that investment total is 120,000, but out of 120,000, subsidiary investment I cannot show. Subsidiary investment should not be shown. So I'm not sure what is inside of 120,000. Okay, let's see what is inside 120,000. Come in here and see. You made in subsidiary, you made a cash payment of 92 and a deferred consideration of 28. And the accountant has recorded the full amounts of both elements, which means that accountant has recorded 92 million as investment and 22 million as investment. So these two numbers, they belong to the investment in subsidiary. So I subtract that 120 minus 92 million minus 28 million. And when I come up here, it looks like 0. It means that they don't have investment anywhere else. This entire investment amount actually belongs to subsidiary. Remove them. It becomes 0. No, then you come to your current assets. Now, sometimes they tell you that you have receivables, you have inventories separately. In this particular question, they are telling me that current assets are 94,700. They have told you straight current assets are 94,700, which means that it includes inventory and it includes receivable. There is no intragroup receivable mentioned. Intragroup trade happened. Party sold to streamer, but they do not say that streamer has an outstanding invoice or whatever. We have not been given that thing. So we will ignore that part. What we need to do here, 94,700 is parent plus 44,650 is subsidiary. So we'll take the total of these two numbers. But then if you remember, group retained earnings, we decrease, and group inventory, unrealized profit in the group inventory, we subtract. We said that debit retained earning, credit inventory, decrease retained earning, decrease inventory, retained earning we decreased. If you see here, this unrealized profit 250, we decreased from the retained earning. This must also be decreased from the current assets. Like inventory part, we should also be reducing in current assets. Then if you take like on inventory, there was a fair value. What is the fair value addition on the inventory? Remember this 60, this 600? This 60. This is on the closing date. The fair value of inventory was 60,000 higher than what is shown in the balance sheet. So I'm going to come here and I will add this plus 60 as well. So this is the adjustment to my inventory part, current assets. I mean, both of these adjustments, one is unrealized profit, which is in form of inventory valuation I decrease and fair value I decrease. It makes me this number 131, just put it up here and I'll make a total. Okay, let's make a total like this. It gives me 615. Let's see what comes there. Sometimes it is possible that an exam when you are doing, your balance sheet two sides do not become equal. Do not spend too much time to make them equal, because it is possible that you might have some calculation or some technical type of mistake. No need to worry, because whichever calculations are correct, you will get marks for them. So even if there's some difference in the balance sheet, we have not, I mean, so far I don't know. But even if there's a difference, I will not spend extra time on that. I will move on. If I can quickly find out there is a number which looks very familiar to me, the number which I've used somewhere, I say, oh, I got it. This 250 was that. But if there's a number which I can't figure out where it is coming from, I'll just leave it and I move. Then comes the equity part. Now in equity part, like I said, that we need to take here, share capital. And share capital we will only take from the parent 190, and we will ignore the 60. Subsidiary share capital we will not use. So this number I take, then I need to take my retained earnings. Okay, and if you remember that, you need to take the retained earning figure which you have calculated. How much retained earning we have calculated for the parent? I'll take this number here. Parent retained earnings are this one, 209,398. This comes in. So I'm not taking this number. This number is not correct, because they did not charge finance cost, they did not charge unrealized profit. In single company, one, they included the full profit on the intragroup sales, but there was unrealized, I need to subtract. Then accountant made a mistake, he did not calculate the finance cost, so I need to find out the finance cost. So I made some adjustments. So this number is wrong. The correct number is 209. So I'll take 209, okay? And then after retained earnings, what do we have? We've got revaluation surplus. So there is no mention about revaluation surplus issue. So we just take the numbers as they are, which is 41,400 plus 4,000. There is no additional note about revaluation surplus. I take them as it is. So this number, it makes me, the total, I would say, equity. equity, you can call it, to the parent. And I'll make a total. Makes me 444,798. After that, you should write down NCI at reporting date. And that is actually, equity to NCI. NCI at reporting date, which we calculated above somewhere. NCI at reporting date, 15,398. This comes up, this number we need, just take it slightly down so that they don't mix up. I just like to leave some spaces. Then you have got your current liabilities and non-current liabilities. In non-current liabilities, you had your deferred consideration. So how much is the non-current liability? In non-current liability, I would write down here, deferred consideration. You know what he's using? He is actually using 28 million, the wrong number. We don't have to use 28 million. We have to use the present value of that deferred consideration, which was 23,996. So this number I'm going to use, 23,996. Plus, if you remember that unwinding of deferred consideration, which was 1920, because deferred consideration increased. Remember what happened? Because we had here 28 million, we discounted it to 23 million, and then we unwound it, and the interest here, 1.9, this one. It will be added, so it becomes 24.9. And then next year, because we are not paying it now, so we record it as debit finance cost, and credit your deferred consideration. It will be added up, so that at the end of 2 years, you pay 28 million. So it is actually 1.920 goes to the P&L as expense, and it also is added to your opening balance. Because 23,996 was at the beginning of the year. At the end of the year, it should be like this. I make a total here. It gives me 25,916. Then I've got my current liabilities, just one number. What is current liability? 137,300 and plus 28,150. There are no intragroup payables. If there are any intragroup payables, I would have subtracted them. Intragroup receivables, intragroup payables absolutely are not available. And we get this number. Now, let me just format them. And now, let's say, Bismillah, 444 plus 15 plus 25 plus 165. And what do we get? 651. And there is a difference. You see, there is a difference. And that would happen many times because when you are doing consolidation, sometimes you skip something. So let's see what is the difference. If we can quickly find out the difference, fair enough, we will adjust it. If we can see that no, there is something very strange number, then we would say, okay, let's leave it and move on. So 651 minus 615, what do we get? 36,396. Apparently, it seems to be a very strange number. We don't have anything as 36,396. We do have
goodwill 32,396.
Sorry?
There is goodwill of 32,396.
Yeah. We've got here goodwill. You see, how much was goodwill? 32,396. We missed in the balance sheet here. Sorry for here. So we missed. Sorry, this is Excel is bothering me. Goodwill at acquisition. I don't know how could I forget this goodwill thing, such a major thing. Just 32,396. I put it here. Now the difference is 4,000. Now what is that 4,000? And that is either increase on the asset or decrease on the liability side. Do you think of some number as 4,000? Any adjustment to fair value or something else? Revaluation surplus. Why should we subtract the revaluation surplus?
We should not add
you should not add the subsidiary revaluation surplus, subsidiary equity, and that should not go. Now you come to the number, it is clear. So two line items were missing, easily found. One was goodwill, the major number, and the 4,000, which was revaluation surplus. Difference is 0, two sides of the balance sheet are correct. It is quite common that when you will be in exam, because this question was rather simple and easy, and still we got some issue. That in real life, when we used to make balance sheets manually, now computers are doing. We always got that problems. Then we spend time to find out errors, to find out mistakes, and to do some adjustments. You don't have this much of time in exam. So in exam, if you come to this such type of scenario, you'll give like one quick look, find out whatever you can, make adjustment, make it correct. Still there is something. Don't sit down and wait 20 minutes. Just move on. Because end of the day, they don't give you marks for making balance sheet equal. That is what only 1 mark. You get mark for every single line item separately in your working. So this is half mark, this is half mark, this is 1 mark, this is half mark, this is half mark, this is 1 mark. So marks are divided like half, 1, half 1. So if you've got one entry incorrect, probably you will lose 1 mark. That's all. Are you clear?